Hey guys, so you want to learn how to trade stocks? That's awesome. The stock market is one of the best places to grow your wealth long term, but it can be a very difficult place to make money in the short term. In this video, I am going to share with you 10 steps that you need to take if you want to start trading stocks today. Now, when I first started investing, there were so many different apps and websites and companies that I could choose from, and I didn't know where to begin. But after some research, I learned about the basic steps I needed to take, and everything was smooth sailing from there. These are the exact steps that I took, and you should do them in order, because once you complete one, then you move on to the next. Step No. 1. Open a brokerage account. A brokerage account is like a bank account, except instead of keeping cash, it holds stocks, bonds, or other investments. It's also called an investment account. And one thing that you should consider when choosing a brokerage account is the amount of time that it takes to open the account. Some will only take a few minutes, while others will take a few days. Also, every single brokerage has a different interface, meaning that they all look different and work different. My favorite brokerage account to use is Webull. They have a clean-looking platform that's incredibly easy to use. But you can also use Vanguard, Charles Schwab, or Fidelity. If you want more choices, feel free to use another brokerage. All I ask is that you don't use Robinhood. Just kidding, no, but seriously, don't use Robinhood. I'm not sure why they're even a thing. Whenever I tell somebody that I invest, they always say, "Oh, I use Robinhood." Okay, I don't care. You can do whatever you want, but just please stay away from Robinhood. Step 2. Fund your account. Once you open your brokerage account, you'll probably want to fund it by linking your bank account. This way, you can easily transfer money back and forth. Most brokerages will allow you to link your bank account immediately, so you can get started right away. So go ahead and fund your new account, and then wait for the money to settle in. Now, how much money should you put into your new brokerage account? Well, that's completely up to you. I would recommend at least $500 to $1,000, because that way you can buy fractional shares and make your investments more efficient. For example, let's say that you wanted to invest $200 into Apple. Well, if you have $1,000 in your account, then you can buy 1/5 of a share of Apple. If you have $500, then you can't buy any fractional shares. You can either buy half a share, or you can find another company that's more affordable. Or another option is that you could just save up more money until you have $500, and then you can invest it. Step 3. Choose your investments. There are 2 types of investments: stocks and bonds. Stocks represent ownership in a company, and bonds represent debt. Personally, I prefer stocks over bonds because historically they offer higher returns over a long period of time. When you buy a stock, you become a shareholder of that company, and if the company does well, then your stock will increase in value. On the flip side, if the company performs poorly, then your stock will decrease in value. Step 4. Determine your investment strategy. How you invest depends entirely on what your goals are. Are you investing for the long term or the short term? Do you want to invest in individual stocks or index funds? What's your risk tolerance? All of these questions will help determine the type of investor that you are and how you should invest. If you're a beginner, my recommendation is that you just invest in low-cost index funds. Index funds are basically a basket of stocks that you can buy into with a single purchase. The most popular index fund is the S&P 500, which includes the 500 largest companies in the United States. Because index funds are made up of so many different stocks, they're considered to be relatively safe investments since your risk is spread out across multiple companies. They also tend to perform pretty well overall because historically the stock market increases in value every single year. Since 1950, the stock market has only had 26 negative years. So, if you invest in an index fund and hold on for the long term, chances are you're going to see a profit. The main downside of an index fund is that they don't have the potential to generate high returns in a short period of time. If you want that kind of return, then you're going to have to do something else, like trade individual stocks. Trading individual stocks comes with a lot more risk because you're re-putting all of your eggs in one basket. If the stock that you bought goes down in price, then you lose money. But on the other hand, if you pick the right stock, then you have the potential to make a lot of money in a short period of time. Now, personally, I think it's best to take a hybrid approach. That means that you would invest a majority of your money into an S&P 500 index fund and then a small portion of your money into individual stocks. That way you lower your risk while still having the potential to generate higher returns. Step 5. Execute your investment strategy. Now that you have chosen your investments and determined your strategy, it's time to execute. With most brokerages, you can buy stocks by clicking on the trade button, typing in the company's name or symbol, and clicking on buy. Make sure that you also set up alerts so that you can get notified whenever your stock trades are executed. Step 6. Monitor your investments. Monitoring your investments does not mean checking your account every 5 minutes to see if your stock went up or down. Instead, it means reviewing your investments periodically, such as quarterly or semi-annually. During these times, you should review how your investments are performing and if they align with your original investment strategy. If they don't, then you should rebalance your portfolio. Rebalancing your portfolio means buying more of the investments that you want to increase and selling off the investments that you want to decrease. Step 7. Keep learning. Investing is a skill that can be learned over time, but it's a skill that needs constant practice and improvement. The more that you learn about the stock market and investing, the better that you'll become at it. So keep learning. If you want to know what books I would recommend, then check out my video, The Best Books About Investing. Step 8. Practice with a paper trading account. If you want to get comfortable with trading before risking any real money, then you should use a paper trading account. With a paper trading account, you can buy and sell stocks without actually owning them. The account uses imaginary money to track your performance, so you can see how much profit or loss you would have made if you were trading with real money. Most brokerages will offer a paper trading account for free. Step 9. Set realistic expectations. As I mentioned earlier in the video, the stock market tends to increase in value over the long term. However, it doesn't increase in a straight line. In fact, it looks more like a roller coaster. So be prepared for ups and downs along the way. The key is to ignore the short-term fluctuations and focus on the long-term goal. And finally, Step 10. Be patient. Investing is a marathon, not a sprint. Sure, you might see people on the news buying and selling options or making crazy trades that seem like they're remaking thousands of dollars in a matter of seconds. But that's not how most investors make money. The truth is that most investors make their money by just buying and holding good companies for decades. So don't try to get rich quick. Just buy good companies at reasonable prices and then hold on for the long term. So there you have it, guys. Those are my 10 steps to get started in stock trading. Hopefully this video gave you enough information to begin investing. If you enjoyed this video, then you'll love the ones coming up. So hit that subscribe button and stay tuned. Thank you so much for watching, and until next time.